Good afternoon. Welcome to this panel, and I'd like to start off by just giving a little bit of context about the family office market. It's increasingly gaining attention around the world, and this panel has a number of distinguished guests, which I look forward to hearing from, both in terms of how they themselves are looking at Africa as a region, but also how they're sourcing investments, how they're structuring those transactions, and how they're executing them and monitoring them thereafter. By way of background, by the way, we could call this the Women in Diversity Africa panel because there's 3 women and there's myself, but we have 1 male coming. But by way of background, I'm the chief executive and founder of RDS Capital, as our MC very kindly introduced me. We are a privately held holding company with interests across public and private investments, but increasingly we've built out an arm where we've done more advisory work and worked with governments, corporations and families. Over the last 5 years, I've worked with a number of organizations, including the Milken Institute in America, as well as the Financial Times as a guest editor of their FT Family Office Research. And then more recently, we are putting together the first family office gathering at 10 Downing Street, which just shows the increasing interest of the family office sector at the government level as well. Today, how do we describe a family office? And I just want to take, for those that may not be aware of it, officially or unofficially, there's many different descriptions, and so I've done this. The following is its simplest form as a private office managing the significant wealth of an individual or number of individuals within a family. We know that the number of staff within a family office can vary quite a bit. Anywhere from 2 to 20 plus employees could be working in the family office. And the type of services it provides can vary dramatically. It can include everything from handling the key assets and the core holdings of more sophisticated families, right the way to accounting and tax, and increasingly more, as we've heard this morning from the President's philanthropic initiatives as well. And as one of the fastest growing regions, which we go to so many events and conferences around the world, and we hear Africa spoken about as one of the most interesting regions, I wanted to start by reading this excerpt from an article I read recently, and it goes as follows. As Africa's economies gain momentum, democratic governments take hold, and continent's young population grows wealthier. Investors are increasingly looking at Africa, and it's becoming easier and more attractive to enter. Insurance and infrastructure assets represent some of the best investing opportunities. We heard from William Hague this morning. He touched on insurance, banking, and infrastructure as 3 of the areas that the government has identified. And if you look at the top performing stocks in Africa in the past year, 3 of the companies on the Kenya exchange, shares in Britam Investment, some of you may have heard of, headquartered in Nairobi, are up 193% in the past 12 months. Pan-African insurance shares are up 127%, and CIC insurance shares are up 73%. Still, with about 20 different stock markets, the disparity that we're seeing in more developed markets and newer exchanges can be vast. So, including adopted better financial standards, Nigeria started a market program that makes it easier to buy and sell stocks. Africa also has, obviously, the benefit of an increasingly young population with 200 million people between the ages of 15 and 24, and many more of them educated than past generations of young adults. Now, Africa is expected to have the largest global workforce by 2040, and Africa's young adult population will be a boon for consumers around the world as they target the largely underserved population. Now, as an investor or as a family office, what does that mean? Well, it's certainly an exciting time to be looking at the region. The International Monetary Fund stated that Africa will be home to 8 of the 10 fastest growing economies in the next 5 years. While South Africa, Nigeria and Kenya provide a wider selection of investments, it's important to realize that those countries probably get a lot more airtime in conversation, but it is the smaller countries that are posting significant gains as well. Stock exchanges in Tanzania, Malawi and Rwanda have all risen by at least 11% in US dollar terms in the last year. So as we're seeing increasing focus on the public markets, in my experience working with families, I've seen a large diversion of the setups from smaller groups who are increasingly investing into funds because they don't have the expertise to source and execute transactions, right the way to more sophisticated families, which we'll hear from today, who are actually taking the time to come to events like this and meet the right organizations and partners on the ground, which they can actually partner with. So in terms of the areas we're going to cover on this panel, we're going to talk about accessing local capital, managing assets locally and finding the right people to work with. How does the investment process differ between families? Because no two family offices we often hear are the same. And we've got an international perspective from Goldman Sachs. Thank you very much for coming today. You've flown in from New York, and I really appreciate that, because having a perspective from Goldman that works with a number of families around the world, which I just heard before the panel, 50 global families of which a subset are increasingly becoming interested in Africa, and not just in infrastructure, but increasingly looking at other sectors as well, will have Ashley sharing her views on that. So without further ado, the way we'd like to run this session is we would like to have 5 minutes or so that we'll ask each of the panelists to go up on the podium just to share a little bit about their offices, their operations, their setup, and then we'll come back down and sit down. Hopefully by that time Christian has joined us, and then we can go straight into the questions and answers, and I'll make sure I leave enough time for the audience to also ask any questions. Put your hands together for Christian. Thank you very much for joining us, Christian. So, without further ado, my first guest, I'm going to ask Lynn Forrester, please take the podium and share a little bit about E.L. Rothschild. Thank you very much.
Thank you, Daniel. Well, we are the intimate group. You should all come up and sit in the front. I know we stand between you and getting your black tie on, so I think we've got an extra onus on us to be particularly interesting. Daniel, thank you for that introduction, and mainly the introduction to Africa. The case for Africa has been made by everyone today, and it is a pretty obvious one. The one point that I haven't heard is the opportunity to leapfrog all the legacy technologies of the West, to be in Africa where wireless completely overtakes wireline, where you can have energy systems that are truly protective of the environment and cost efficient. You can have education through computers. Africa is going to be able to leapfrog so many things. And as President Kagame said earlier this morning, that the challenges of Africa, which are many, are also the opportunities. And in terms of the way that we look at family businesses, is Daniel's right about the family office, but if you take family-controlled wealth around the world and the assets under management that are controlled by families as opposed to institutions, it's $46 trillion. So it's half of all investable assets in the world. So family is not a small unit. In the United States, between 80 and 90% of all businesses by number are family-owned businesses. And in Europe, it's 65 to 85%. As a contribution to GDP in the United States, it's family-run businesses that contribute 50%. Same is true in Europe. In America, there are 100 businesses that are completely family-controlled, worth over $1 billion each. And if you take, so when we think about family-owned businesses, we think of two things. We think of family-owned and managed, and then families as investors. The family-owned and business and managed model is a really important driver, and it is also the model that I think is so important in Africa, because it's the model where a family sees a niche, an entrepreneur sees a niche, and decides to sell whatever it is, from agriculture to widgets to energy, and then runs that, makes the fortune. And then what we've seen in the West is how many generations does that management pass down? So of all family-owned businesses, only about 5% make it to the fourth generation, and in terms of owning and managing. And often that's a very good thing. So we had in the United States in the 20s, 2 big retailers. They would be like the Walmarts of today, or the Sears, or the, what's the biggest British? Sainsbury, right, big companies. There were 2 of them. One was Montgomery Ward, one was Sears. When they got to the second generation, Montgomery Ward said, we are keeping management in our family. Sears said, actually, no one in our family wants to manage it. So we are going to bring in outside management, but keep control of the asset. And obviously, you've never heard of Montgomery Ward. That went bankrupt in a few years, and Sears continued to be strong until it got in the hands of funds. So that owner-operator model for family businesses, I think, is really important in Africa. And Rothschild Bank is on its 5th generation. I run the family business, our investment for my husband and me. And what we do is we go and we try to partner with those startup companies in Africa. And we think that as a family, families can trust us. They know our heritage, first of all, in terms of being long-term investors, in terms of caring about reputation, and being there through good times and hard times. We are one of the large family investors in The Economist magazine, and we've been in that for 70 years. That was an investment that took the first 50 years to develop its brand, its content, its global distribution, and now it's heralded as a great, a great return for shareholders, but it required a long-term view. So we find that when we go into countries and we have investments around the world, people respond to the fact that we are a family vested alongside of them. The other thing we have found is actually private equity firms partner with us. And sometimes the problem for a family going with a private equity fund is that if you care about your business, in something between 5 and 7 years, they're going to have a liquidation event. When we go in with a private equity fund, we look at possible ways to not liquidate, but of course, a good return is something that we're always very happy to do. We also provide for private equity funds. We're not competing with them. We are our real partners. So long and short of family-owned businesses, for me, is I think that it has a sort of perfect circle, a virtuous circle of a family's interests are in, if its name is on the door, it wants to make sure that it's providing services or products to customers that they want, and we stay in the business. And we can stay in through thick and thin, a little bit better than if you have to report quarterly earnings. There's a huge virtue in that. And I think for the markets that family companies operate in, they are better off because, again, they're caring about their customers, they're caring about their community, and they're caring about building something for future generations. And the exciting thing to me about Africa is really beginning to think intergenerationally. What am I leaving behind and what am I building? So that's my short.
Thank you very much.
I hope
Next, I'd like to invite Ashley Fernandez to give a perspective as the head of Goldman Sachs's US family office business as to a macro perspective of what they're seeing and a little bit about their group and some of the trends.
Thanks, Daniel. As Daniel mentioned, so Ashley Fernandez, I work at Goldman Sachs, and I have perhaps a slightly more umbrella point of view than the rest of the panelists here, in the sense that I'm not a representative of a family office, but an advisor to the family office community globally. As Daniel said, I run Goldman Sachs's family office coverage group for the United States. However, as I was saying earlier, it's such a global community that, I think geographic boundaries don't necessarily contain which families you spend time with. For the last several years, we had been watching at Goldman with interest what I'd call a rapid evolution of the family office community and their approaches specifically to direct investing. And I should caveat that my comments are going to skew towards the direct investing or private equity style investing, because that's where we tend to focus, which is obviously one end of the spectrum where family offices focus. We estimate there are over 2,000 family offices globally, and as Lynn was alluding to, they control quite a lot of assets. We estimate several trillion assets. Primarily, those assets are in the hands of single family offices. And many of these family offices have been hiring dedicated private investment professionals to make and manage direct investments really increasingly over the last decade, and are, as a result, building significant portfolios of what we'd call non-core assets, in the sense that they're not what the family wealth was established, they're not the family wealth business. A little over a year ago, we at Goldman Sachs formalized an effort within our investment banking group to cover this important and increasingly influential community, and as Daniel had alluded to, we currently spend probably actively time with about 50 family offices that control, I would say, on average, over $5 billion each, and do private equity style investing. And we cover them almost exactly as we do our traditional private equity clients at this point. And the reason why is we see this group not only becoming larger and more active over time, but secondly, it's a very differentiated pool of capital and a very different buyer or investment universe. The reason is that, relative obviously to strategic capital, traditional institutional capital, or traditional private equity capital, the reason is, one, they're ultra long-term in horizon. They don't think about investment time frames like a public investor, which could be days, or private equity investors who typically think 5 to 7 years. Family offices tend to think decades long because it's intergenerational. Second point is that family office capital tends to be substantially more flexible, both in structure but also in how they think about and define returns. There's no IRR definition that they need to accommodate third-party investors. Thirdly, they're extremely varied in investment styles and objectives. And fourth, there's limited desire to operate or being really hands-on in the day-to-day operations of the business. So, that said, they also have the ability to contribute significantly because of all the relationships and contacts that a family typically has to help build that office from a more passive investment perspective. For all these reasons above, we view that single-family offices are uniquely positioned to have a meaningful investment impact on the African, investment structure, because primarily because of this long-term horizon. There's a significant amount of patience behind the family money that allows them to live with, as Lynn was alluding to, the ups and the downs of business over what can be decades. So, which types of families do we see really making active investments in Africa? Admittedly, it's certainly a subset of the overall family office community. The traditional family office, as you might think about it, is highly conservative, anti-taking aggressive risk, and focused solely on wealth preservation for future generations. And certainly that set of families do exist, and frankly, they do still invest in Africa. It just tends to be more through the philanthropic side of the organization. But as part of this significant transformation in family offices, we really see an emerging set of families taking new approaches to investments in Africa. And I would categorize those families into 3 buckets. The first are families that have come to understand Africa more or less organically because they have exposure to Africa already through the underlying business. For example, one of our clients who is involved in a global brewing business, they've come to know Africa probably better than anybody else over decades, and really are at the forefront of what we would call aggressive and active, proactive investing in the region. A second type of family that we see in the space are families from other emerging markets and who may be recent billionaires but understand the concept of potential political instability and or living through kind of a higher risk geopolitical situation. And then the third set of families are those that are really not yet multi-generational and are headed by naturally risk-assumptive individuals. And what I put in that category are oftentimes more of the hedge fund investors who are just by definition willing to be a little bit more, as I said, risk-assumptive. If I were to add one caveat, it's that these families are focused on economic returns, and that is, obviously something that they're not going to change. And as a result, if I were to say one theme that is consistent across all families is that they do view investing in Africa as opportunistic. While it may be while it may be selective and opportunistic now, I think that what we clearly see is we're at the front end of a trend, and as more and more families gain more and more exposure and become more comfortable with the region, I think we are going to see more families who are just natural partners in the long-term development of the region. So that's my couple of minutes, hopefully not too long.
Thank you very much. May I next invite Heather de Haas, please, to take the podium.
Good afternoon. I'm actually directly representing a family office, my own, which is now third generational active. It's a real pleasure and privilege to address you this afternoon. And firstly, I'd like to declare my interest. For 3 years, we have been involved as a family in a large project in Sierra Leone. But the country is in crisis now. And on behalf of the Global African Investment Summit, I'd like to convey to the people of Sierra Leone our deepest concern for their terrible suffering and our sincere hope that the Ebola epidemic will be contained and eradicated sooner rather than later. Clearly, interest in investing in Sierra Leone has dried up over the last 6 months. Our strategy as an investment group, stroke family, looking at this country is to have our funding and our plans ready to implement on the day that the crisis is declared over and the country is safe once again. We want to help Sierra Leone demonstrate to the world that the country is again open for business with absolutely no delay. Permit me please now to state something you already know. The old Chinese proverb that if you give a man a fish, he'll be fed until tomorrow, but if you teach that man how to fish, he'll be fed for life. It's so obvious, but the reality, at least in much of Africa, which my family has come to love and treasure, is that this proverb is actually not the guiding principle behind Western investment and support. There's a very good reason for this, however, and it's this reason that I'd like to briefly discuss with you today, along with my strategy for resolving what I see as something of an impasse at present. I started my own life as a professional musician and a teacher. When I came to London from Australia many years ago, I became involved in business. Now I'm fortunate to combine my two passions. My own website, artsglobal.com, addresses the commercial side of my life. This deals mainly in property and fine art. By contrast, artsglobal.org expresses my artistic and philanthropic side. My foundation, Arts Global, is registered as a charity in England, Switzerland, and the United States, and our tagline is that we are a foundation that empowers emerging artists and we advance social change. The combination of business and philanthropy, which now guides my life, has led me to the phenomenon known as the triple bottom line investing. I'm sure many of you here today know of this, probably, and practice it in your own investing. So forgive me if my summary of the triple bottom line investing is familiar to you, but it's of crucial relevance when it comes to either eating the fish or going fishing. The three pillars of triple bottom line investing that my family follow are financial viability, social responsibility, and ecological sensitivity. More and more investors are demanding the presence of these three pillars in any project they become involved in, and nowhere is this more crucially important than in Africa. 3 years ago, a member of my family, stroke investment circle, made the point to me that virtually every diamond mined in Sierra Leone is exported in its rough state. All that the country gets out of its diamond mining, apart from some employment in the mines, is a 3% export tax. My colleagues suggested that what the country needs is a school teaching the cutting of diamonds, the working of the gold, the design and manufacturing of the jewelry, and the basic ethical business principles. It's so obvious when you look at it. The school will produce craftsmen and entrepreneurs who will in turn go out into the Sierra Leonean community and add value to the nation's great heritage of precious minerals. Employment, enterprise, and wealth will be generated in equal measure, and the country will prosper. So why isn't everyone doing these simply defined good things for African nations that are so rich in mineral resources? A school is a philanthropy, and a gemstone school is a particularly expensive one at that. It's not enough for an investor to throw money into a charity just out of the goodness of his heart. It's not so much the capital outlay as the inevitable problem of sustainability. When the money runs out, the school will fail, and that will be that. We've all seen dozens of examples of projects floundering on the rocks of what were good intentions. So through the triple bottom line investing, we've structured the Gemstone School so as to be located on an ocean-front site, which will also serve as a tourist resort. It's in a picturesque, unspoiled, and underpopulated region just south of Freetown, which has been designated as mining-free and industry-free. A new road will open up into the area, which will need a shopping mall, a medical centre, and all sorts of other commercial amenities. Our project, which has the strong blessing of the Sierra Leonean government, will provide these amenities, and in so doing will give our investment group the opportunity to achieve a very solid return, the first pillar of triple bottom line investing. The other pillars, which are social responsibility and ecological sensitivity, will follow out of our conviction that this is what's right for the world right now, and encouraged by the environment in which the project is taking place. I present this to you as our particular solution to the challenge confronting African development. The solution was there for us to find, and it took us some time, but we got there, as I am sure you will in your own particular endeavours to assist the African continent into the future. In closing, I'll make just one point, if I may. Sierra Leone is a country where a broad base of consensus to any activity is crucial, if that activity is to proceed. This can be an advantage and a disadvantage, but that's what it is. So we have painstakingly built what we call the coalition of consent, ranging from national government through regional government to local government, and then, most importantly, the local stakeholders. It's taken time, but it's yet another pillar in a project which is designed and structured to deliver a win-win solution to a problem. And it's a win for investors and a win for Africa. Thank you.
Thank you. Heather, thank you very much. And may I invite Christian Angermeyer, founder and CEO of Aperian Investment Group now.
Yeah, first of all, sorry for being late. However, I was thinking if being late always means to be the fourth in row after 3 gorgeous women, and Daniel, of course, then maybe I should be late all the time. So about myself, I'm running my own family office. It's not second or third generation. I had the luck. I started when I was 19 a biotech company, although I had no clue of biotech, but the 2 other guys had. It turned out to be a very good invention they had made. We IPO'd in 2002 at 500 billion. Today it's 6 billion. Unfortunately, I sold way too early. Yeah, however, I made a little bit of initial fortune and then went on. Actually, I quit university, which is maybe not a good recommendation, but I went on investing, and today I invest actually in Germany. This is where I'm from, what maybe the accent tells you, and in Africa, which is my big passion. And I invest in 4 sectors: in financial services, technology, life science still a lot, and media and entertainment. Maybe let's go back to me being late, because this is what I was thinking when I came here. Yeah, what had happened is my meeting started late, which I had to take. Actually, I live here, but I had to be in Germany. Yeah, because the trains or the train people were on strike in Germany, so my meeting started late. Then Lufthansa was on strike, and my flights were cancelled. Then I was on a BA flight, but then the BA flight was just late. Yeah, what I was thinking, if the conference were in Africa, I would just have said, okay, this is Africa. Yeah, but it was actually Germany and a little bit of UK. Yeah, and this is my main point. What I want to highlight is, I think what still needs to be changed, because Africa is what I think much, much better than the perception, is the perception of international investors and so also family offices, yeah, who think about Africa. And I always say I'm the living proof, because my history in Africa is that I had no clue of Africa at all, maybe aside where it is, and that there are a lot of beautiful animals, till 2007, yeah, till a German government member, I'm a little bit politically involved as well, yeah, in Germany, said, oh, the president of Rwanda is in Germany, and he has a free evening, can somebody host him? So I was like, well, sounds interesting. Yeah, I have never been to Africa though, but I will try to make a nice evening. So President Kagame, as you might know, if you have met him, yeah, is a very convincing person. So he told me a lot how amazing Africa and Rwanda is. I told him frankly that I have never been there and I have no intention to go, because I think I'm gonna die if I touch the ground. Yeah, because I was extremely hypochondriac at this time. Yeah, and I literally thought you touch Africa and you're gonna die of malaria or something else. Yeah, so he was very, very pushing. And actually his office called twice after the meeting in Germany and said, you have to come to Rwanda, because a little bit your views on Africa are a little bit hilarious. So finally, really, I was canceling it almost the night before. It's a long story, I shorten it. Finally, I went with a doctor, yeah, no joke, so with some other people. And then I came to Rwanda, and it was literally amazing. Yeah, and I had never been, as I said, to Africa before, but I decided when being in Rwanda, that actually and that's my main message for the investors. So for the Africans here in the room, the main message is spread the news, how awesome the continent is doing. For the investors is most investors think about risks, whatever, but it's also in life about arbitrage and about risk pricing. Yeah, if the whole world, or the whole Western world at least, is thinking about Africa. And I think it changed a little bit, but to be honest, I always tell this story because there are a lot of white people in every room I speak who think the same. Most of them just don't dare to talk about like I do. Yeah, but most of the white people think like I do. Yeah, there is a huge arbitrage value to be captured, because if the whole world still thinks a little bit about Africa like I did in 2007, but the reality is what I then perceived, or what I experienced when I came to Africa, there's a huge arbitrage to be caught for the frontier investors, for the first in line, yeah, to invest in Africa. This is what I thought in 2007. I started a company which was or is called ADC, African Development Corporation. We just merged, yeah, with another African company, Atlas Mara. Yeah, ADC, yeah, is a banking holding. We had or have banks in 11 countries in Africa, and it went really well. There was a lot of, I also say that, a lot of headache the last 7 years. Yeah, it's not whatever easy go. Yeah, but I would immediately do again. Yeah, and I also like going on investing in Africa. So the only thing I want to add, time is over, yeah, is like I'm an entrepreneur myself, so I would rather say an entrepreneur than a family office. I think this is what the continent needs, yeah, aside of outside investors coming to Africa. The continent needs entrepreneurs to capture the opportunities, to capture the money, and turn it into good businesses. Thank you.
Thank you very much. So there we have it, 4 very different perspectives, but all very valid. And I'd like to now move to the questions that we had prepared in advance of this panel. And I want to start with the following. So we heard from Ashley the very high-level overview, the macro view of kind of how we're seeing increasingly a subset of the global family offices, single family offices, but no doubt multi-family offices increasingly looking at the region. But we also heard 3 very different perspectives of how these families are going into this market. From Christian's perspective, where it was quite an entertaining one, I must say, right the way to where yourself, Lynn, you've built businesses outside of Africa, but now increasingly moving into partnering, as you used the term in your introduction. So my first question is for you. When you are now increasingly looking at the region, we know that just in the same way as many families looked at China and some of the other markets around the world, it was very difficult for them to do it on their own. So finding local partners was a big part of the story. And I'm very conscious of the fact that you spent a lot of time investing in your team, in finding those partners on the ground. I'd like to understand, and the audience to understand, how you're going about doing that. But also, more importantly, touching on Heather's point, how do you then think about taking that backing of a partner to bringing in co-investment and then scaling a business interest? Because I think in the introduction, we heard very high level, increasingly the focus on the public markets. But I think one thing that the 3 panelists, and also from Goldman's perspective that we're seeing, is this increasing focus on the private markets, the direct investments. And when you're doing these direct investments, it's been increasingly an interest, especially since the credit crisis, where 10 years ago we were talking about the most attractive hedge fund to be in. But today we're seeing families going back to their roots, wanting to have certainly more control and more influence around the factors that influence the investments that they're in. So, Lynn, could you share a little bit about how you're doing that? And are you also open to other families working alongside you? And also an open question for the rest of the panelists. Are you open to other families working on the expertise and the lessons you've learnt in acting and operating in that region?
Thank you, Daniel. First of all, I think that what you concluded with is exactly what we do. We're less of a family office and more of a family business.
Absolutely. And
our business is finding businesses to invest in. To your final point, that funds, from hedge funds to private equity to long-only funds, have proven to be not always alpha, right? That's why CalPERS has recently decided they're no longer going to invest in the hedge fund industry. There's more and more interest in doing direct investment. Now, direct investment for us has taken us in everything from media to technology to agriculture to financial services, which means the only way we can succeed is by having a good local partner.
Absolutely.
So for ourselves, and until this time we've only invested our own capital, our number one risk factor is who are we investing behind? who are we trusting when the rubber hits the road to execute? That to us is the most important thing. And that entails everything for us from competence and experience to integrity. And we spend a lot of time getting to know the people that we're in business with. And to your second point, so because the opportunities in Africa are so vast, and I have a little different view of the risk in Africa from Ashley's, because I actually think that on a risk-adjusted basis, the returns justify the risk, and that actually it's an uncorrelated risk. If the New York Stock Exchange goes down, it's unlikely that you're going to, by definition, lose money on your agriculture or your power or your road deal in Africa. So actually, I see investment in Africa for us as a risk mitigator. That's one thing. And then also, in terms of your question about working with other families, we are now keen to do that because we see so many opportunities in Africa. But we will always stick to our primary focus, which is, first of all, I'm more nervous about losing someone else's money than my own, which is why I never wanted anybody else's money. But there are vast opportunities to put to work big amounts of money. And so we will start with the local partner, the operating partner, and talk to other families.
Would any of the other panelists like to comment on that? Actually, a question for you. So what we're seeing increasingly, if you look at the Global Family Office research statistics, the Financial Times research identified a 9% return is the average return that's looked at among a group of 180 global family offices. And I think the number is actually completely irrelevant for when we're talking about the Africa region. There are so many other factors that come into place when you're talking about the region, and particularly part of it is the fact that it's so relationship driven. Secondly, the fact that they are extremely opportunistic, many of the families that are looking at the region. And we touched on the fact that a large degree of families are increasingly looking and have looked at infrastructure. Do you think that that's changing? And if you see it changing, what other sectors is it moving into? We heard this morning William Hague talk about banking, infrastructure, and what was the third one? I can't recall now.
Insurance.
Insurance. And clearly in the public markets, we're seeing increasingly interest in the insurance and banking sector. You touched, Christian, on Atlas Mara, which appears to be relatively successful so far. I understand you've had some involvement in that as well. So actually, back to you, how do you see the kind of the investment return versus the opportunistic nature, and how do you see those trends moving? Because there appears to be a lot of families interested in the region, but are they actually looking at other sectors outside of infrastructure, and how do you shift that focus to look at broadly those other two sectors that we touched on earlier this morning as well?
I think infrastructure is the obvious area for most families because it's, it's something that is very stable and very easy to get your arms around, and frankly not necessarily quite always so tied to what's actually going on the ground. It's part of a bigger sort of macro approach to the region. So I think that's definitely where the majority of the families that we deal with that have major investments in Africa today, that's where they are now. That doesn't mean that's not where that they're open-minded to new and other parts of the economy. And I would say that as you think about, and this is one of the interesting things about family offices specifically, is they're not focused on what's happening over the next 5 years. They're focused on what's happening over the next 50 years.
Absolutely.
And so I think for that reason, that's why a lot of families, and we've definitely been talking to families about the financial services space, which I think is sort of the next step when you've got sort of the infrastructure on the ground. How do you facilitate the economy? That's the financial services side of the world. All right, and what's the next step after that? That's consumer products and things along those lines that take advantage of the emerging middle class in the region and so forth. So I think that a lot of families take the tact of, all right, what's happened in Brazil over the last 30 years, Asia over the last 30 years, and how do we translate lessons learned in those regions to Africa as indicators of what's likely to be, steps 2 and 3 after the infrastructure is built. So that's that's kind of how we interact and how we see families looking at the space. And I think the one other thing, just to add on to what you were saying about families being opportunistic and how they think about the region, I think one of the other things, just building on what Christian was saying earlier, that the families who are looking at the space see as a major positive of Africa, aside from obviously the massive opportunity and the risk-adjusted rewards for the families that are willing to invest in the space, is it's just so much less competitive than the rest of the world in terms of, you try to find a family-owned business that you can become a minority partner in the US, and you're competing with, KKR and Blackstone and every other family and every other family globally. It's just, everything's an auction process. In Africa, and you don't get necessarily the best price. When you think about the opportunities in Africa, they're everywhere and nobody knows about them, so you sort of have your first and only look, which also massively changes the return profiles, to your return question.
So it's interesting because when you look at the Western markets, you look at the developed family offices, large families of $500 million plus, you see a much more diversified, more wealth preservation strategy. And you see this complete dichotomy in emerging markets where wealth is being created, much more concentration risk and much more opportunistic approaches. So when you see actually a situation where increasingly we touched on the interest in directs, what role does the bank have to play today? And how do you add value to that process when you are able to either access opportunities before the rest of the market can see them? Because no doubt one of the key things we want the families to be all aware of is it's about accessing opportunities, what we call off-market. So how are you playing as a bank a role in sourcing opportunities, and how do you define how those opportunities are shared between those clients?
How do we do that? So our role is, first of all, we have this global network of families, many of whom know each other, but many of whom do not know each other. And so, I guess on one end of the spectrum, that's one end of the spectrum, obviously, family one looking for a partner in a situation where we can make introductions to other families that we know that they may not have come across that could be potentially interesting investment partners. On the other end of the spectrum is, between Goldman Sachs's infrastructure, where we're coming across our corporate clients making investments in spaces who are looking for potential family partners because they need long-term capital partners in a project, and I think that's a lot of what we've been seeing in Africa as an example, it's all sorts of, sell-side opportunities, minority investment opportunities, private placement opportunities along those lines, where we try to essentially matchmake with families that we know have interest in a given space and a given profile.
Christian, a question for you. It was a very interesting way you got involved in Rwanda as a market and have taken the time to go out there. Have you looked at other regions since you went out there? And how do you see your investment strategy changing over the next sort of 3 to 5 years in the region?
You mean if I have to other countries than Rwanda? I think it was like 50 times in Africa the last year, so a lot. So also to other countries, not just Rwanda. I think, meaning there are so many opportunities, it's very hard to say, or it's not like, I don't want to set an example or say this sector or this area is more interesting than the other. I personally grow fond, especially in the last 12 months, the more I look more on the listed stuff in Africa, because what you have to say is, because it's a very, very frontier, meaning, and actually, by the way, also we do generalize a lot. We talk about Africa as it would be one country, that I have to say first, because there are countries who are a little bit different from others, but in general, it's an entire frontier market. So if you go in private companies, you have to be really, really hands-on. So that limits, definitely for me, the amount of deals you could do in private companies. When you go in listed companies, you actually get companies which, compared to European levels, you could say are still very venture, so very early, but they're already listed, so they have a minimum of corporate governance, a little bit of organization. So I look a lot on getting larger stakes, so practically strategic or hands-on stakes, but in listed companies.
Mm-hmm. And has that been successful to date?
I'm happy. I'm in general a very happy person, so that's like easy to make, but I'm also happy with my African returns, yes.
Fantastic, thank you. Heather, I loved your description of the triple bottom line investment approach. You've been very active globally in property,
Yes.
not least in the United States, in Switzerland and in the United Kingdom, and now Africa as well. Do you see yourself doing more beyond the work that you've already done in Sierra Leone, in the regions and other regions? If so, what other areas have you been considering, and where do you see the future for your family in relation to the broader asset allocation in Africa and how you're thinking about the next generation?
Well, as I say, we're now a third generation family office, and one of the things that we're very focused on is getting the younger generation very involved in our projects. So 3 of them have spent a serious amount of time to date in Sierra Leone on different projects, most of them working with some of the underprivileged children, teaching them certain language skills. I think as a family, we for sure share a passion for Africa, Daniel. I've focused on Sierra Leone today simply because I wanted to illustrate one of the projects that we're involved in. And to the degree that that's developed, I see tremendous ongoing potential, probably into 2 generations' future. We're talking to partners now when it comes to developing the resort destination, because being an Australian, as I'm sure you all know that I am, wearing my Kubra hat, I have seen some beautiful beaches, but I can assure you the most beautiful beach I've ever seen is the one in Sierra Leone. So going forward, Daniel, I think there are other areas of Africa that we will look to as a family, but for right now we're focusing on this particular venture because it has many offshoots.
Thank you, thank you. I want to give the audience a chance to also interact with the panelists, because I'm sure, as you've all heard here, these different perspectives. Has anyone had any experience working with family offices to date in the audience, or you have any questions that you'd like to ask the panelists at this point in the program? So I'm conscious of time. Please, do we have a few more minutes for questions? 2 more minutes, great. Please, could you announce your name and your company?
Yes, Stephen Forshaw from Temasek. Heather, welcome, and nice to see another Aussie
Another
in the
Aussie.
room.
Thank you.
A question for the 3 family company representatives, and then an extension of the question for Ashley, if I could. Are there any sectors which or businesses for philosophical, ideological or other reasons you just won't touch, and why? And Ashley, are you seeing any trend in any of the sort of no-go areas for family offices, family companies in areas they won't invest? And what are some of the trends that you're starting to see in that space?
Do you want to direct that question to the panelists first and then to Ashley? Christian, do you want to?
Well, I think this is the obvious. I mean, I do investments in the sectors, in the 4 I mentioned, where I did investments before, and as I'm a little or actually not involved in weapon trading in Germany, so I don't do it in Africa as well. No, joking. But this is like the obvious thing what you don't do. I think the other range of serious businesses is depending on the family, what the experience is, what you feel comfortable with.
Heather?
I just have to answer that really. We have just been very focused on getting to know the one region, and it's been a very slow process, and I've had to learn tremendous patience, which I'm not normally good at. Dealing with certain governments, government officials, local people has been a very rewarding experience, but to be honest, also a very frustrating one. So I think from my perspective, certainly going forward to my son's era, we have to remain focused on the area that it's taken us a long time to build relationships within. It's building relationships and trust, and then having that ultimate loyalty that I think will underpin success in very many parts of Africa.
Lynn, would you like to add anything?
Well, what you're referring to is really a trend beyond a family office trend. It's really a trend across the minds of huge asset owners. You are probably referring to the Rockefeller Foundation that recently announced it will no longer invest in oil and gas. Stanford University has said they'll no longer invest in coal. Personally, for us, we are interested in energy development, but we are interested in renewable energy development. We will not be investing in coal development in Africa, for instance, just because there's enough opportunity to invest in good places. The other, it's not a sector, but for us, integrity is really, really important.
And Ashley?
Yeah, I mean, it's hard to answer. It's just in the sense that families are so all over the map in terms of where focus is, and so what's a no-go in one family is a go in another family. I'll say one key theme, obviously, is that a no-go is anybody where you're investing with somebody that you don't trust. I mean, because that's the single most important, especially when a family is more in a minority or passive position, which typically a family office is. That's obviously a critical piece. But I guess the other thing that I would say is anything that could get a family in the newspaper for the wrong reasons, no way will that happen. And then I guess in terms of sort of a more generic sector type of answer, look, one family that I have spent time with who's very active in the region articulated it this way to me, which is, look, when I'm in a higher risk region, I like to be in a lower risk sector. And therefore, and when I'm in a lower risk region, I like to be in a higher risk sector, because it's all about balancing return dynamics. And so in the US, I might invest in tech. In Africa, I probably wouldn't. And so I think that's kind of how families think about it right now, which is go for the more stable, steady, today infrastructure style type investments, which you can sort of bank on a little bit more consistent returns within maybe a little bit less consistent environment.
Thank you. Just one last comment from Lynn, and then we're going to wrap up.
All I was going to say was I'm glad that Tomasik is asking that question, because actually what we're seeing in the world is if investors begin to think in a broader way, yes, they start to think about the ethics of their investment, and they start to think about the broader stakeholders, maybe, triple bottom line is kind of that's like the deity. But the fact is that if $90 trillion decided that they are going to, or if 1/3 of that decided that they're going to invest in companies that think about broader social returns as well as economic returns. Never give up the economic returns, but there's no great correlation between investing in, guns, dirty energy, and, bad guys as a big return. So I think that question is really important to the entire investment community, not only to family offices.
So may I take this opportunity to thank Christian Angelmeyer of Hyperion Group, Lady Lynn Forrester de Rothschild, via Rothschild, Ashley Fernandez of Goldman Sachs, and Heather de Haas of Arts Global. Thank you very much indeed.